Welcome, everyone, to this week's edition of the Commercial Real Estate 101 podcast. Excited to see you all this fine afternoon. For those of you guys who are tuning in for the first time, we started this group back in 2020 to kind of be a watering hole for commercial real estate. We wanted people to be able to have access to people from all across the country that are sharing unique insights about the commercial real estate industry. And today we have a friend of mine, Stephen Lukinovich, who I've known for several years now. We actually serve on the CCI board together. And when the big, beautiful bill came out, and there were so many questions about how it's going to impact the commercial real estate industry, he was the first person I went to after a board meeting and said, hey, we need to do a podcast about this because I'm sure there's going to be a lot of people who have a lot of questions about it. So first off, Stephen, thanks for taking the time to be here. So
good. No, thanks for the invite, and I look forward to the discussion.
Yeah, no,
And we're going to focus today just on the real estate aspect.
Correct. Yeah. And to your point, the big, beautiful bill doesn't just encompass real estate. I mean, there's a lot of business aspects to it that apply to other industries, but we will focus strictly on the real estate piece today, which I think will be helpful for those who listen to the podcast.
If we do more in real estate, I'll have to charge you.
Oh, okay. There you go. Yeah, that's exactly right. Yeah, he's going to send me an invoice after this. But no, I just kind of want to start out. I think first off, what we typically like to do is learn a little bit more about the person who's across the table. So if you don't mind kind of sharing a little bit about what got you into the business, that'd be great.
Good. I started public accounting in 1988 in New Orleans. And so graduated, was married early in the 90s. And my favorite wife, she's my only. She said, when I graduate University of New Orleans, we're going to move north near my family. So I told her, I said, I don't recall reading that in oral prenuptial. But nevertheless, so I started with then Chilton and Medley in December of 95. So I've been with the firm since 95. We've been through various mergers. When I started in 95, we had 22 people. Today we got over 2,000, so I've seen a lot of growth. And I've been practicing my emphasis in real estate probably for the last 25 years.
Awesome. Yeah, no. And then you've talked about the evolution of your firm and how there's been, somewhat of consolidation and growth. And so that's been really exciting to see on your all's end. But
thank you.
I think that the question that is on everyone's mind is, I mean, number one, what is the big, beautiful bill? I mean, that is something I'm sure that everyone's kind of questioning.
It's predominantly an extension of provisions that were going to expire, and they were going to expire, the end of 25. So substantially 25, 26. And so Trump wanted to extend it. He's the one that put in the first legislation in December of 2017 that had many of the provisions that were going to expire. They were temporary. So he wanted to make them permanent. And essentially that's what occurred. They're permanent.
Awesome. So it is more of an extension on the tax cuts provided by Trump during his presidency. But then there's also several other items within the bill that we're going to get into that are going to be applicable to what we're doing in the real estate industry. Some of which already were in the previous bill and maybe were, brought back to what they were before. But then also some things that there's some reorientation of how they're approaching that process. Is that correct?
Yes, there were phase outs. There were provisions that were going to expire. And then, just as you're alluding, there's brand new items that apply to real estate that are in the legislation.
That's awesome.
That's in the legislation.
So to start out, I think one question that was, I know, a big topic, even starting 5-6 years, when this particular, strategy came out, I know it was kind of all the rage for several years, and that's opportunity zones. I know we talked a little bit offline that I myself, with a business partner of mine, have acquired a property in a growing market here in Louisville through an opportunity zone fund. So I'm somewhat familiar with the process of how it works, but if you could elaborate a little bit on, number one, what are opportunity zones, and number two, how have they been modified with the existing bill?
Fantastic. OZs are census tracts across the country that were originally designated by governors in 2018. So if you do a project, which, by the way, does not have to be real estate, it could be it could be a restaurant, it could be a manufacturing operation. My experience is, over 90% of them are real estate projects, OZ real estate projects, because of the appreciation, which I'll explain here in a minute. So one, in order to take advantage of the OZ incentive, you have to realize a capital gain. So you have to sell something that generates a capital gain, section 1231/capital gain, and then roll that gain within normally 180 days. That can be extended for months, which might be a little bit beyond what we're talking about right now, but it's normally 180 days. You roll that gain into an OZ fund, which is what you did. And then that fund invests in a business called a QOZB, and the business is the operating activity. The business in real estate would own the property, redevelop the property, and it would be owned typically 99% by the fund. And then the fund might have a variety of OZ investors in that fund.
Yeah, no, 100%. So with that, what you described as different census tracts around the country that were designated by the governors of those states to describe site areas that were considered to be blighted or areas where they would like to see more investment in. So I guess regarding that piece, how has that been affected by the new legislation?
So beginning 1/1/27, sometime in 26, I think it's the second half of 26, the governors are going to reselect.
Okay.
And they're going to designate tracts in 27. Notice how I didn't say new tracts. They're going to designate census tracts in 27, which could include existing tracts. The new tracts are going to have a higher threshold for lower economic activity, in those census tracts. So the census tracts are going to have to meet a higher threshold, but some of the existing tracts could be included in the tracts that'll be designated 1/1/27. And that all will take place the second half of 26.
Interesting. So how does that work with existing tracts? So for example, let's take an example for us where we bought a tract or we bought a building using this strategy in a particular census tract. If in fact, in that future scenario, that tract is no longer designated as an OZ, how does that affect previous OZs?
The short answer is there'll be no impact. That's the short answer. So any projects that have been properly handled, the improvement took place correctly. The deferred gains were properly invested. The OZ properly invested into the project. The project is properly doing what it needs to do. There'll be no impact. However, just to say it, we are looking for guidance. We are looking because clearly these existing tracts, many of them will expire. I think they're going to expire the end of 28, technically. And even so, you'll have this little overlap period. But in any case, they will expire. And truthfully, we want to get guidance on your exact answer. But I think the short answer is there'll be no impact.
There'll be no impact.
As long as everyone did it properly, you're going to be fine.
Awesome. So, as part of the OZ structure, the way that it was set up before was that if you held that investment for a certain period of time, there were some tax benefits associated with that. So if you could elaborate a little bit on, the different benefits and how they've been modified as a result of this new legislation.
Good job. All right. So I'm going to tell you 2 or 3 things then on this. So one, when you recognize your gain, you realize your gain, you defer it. So if you properly roll it, in my example earlier, 180 days, you would not pay tax on that gain until 2026. And you don't pay tax on that gain actually until 12/31/2026. And then any tax due on the recognition of that gain in 2026, you will need to look at your fourth quarter tax payment, which is due January 15th, 27. So you'll have your fourth quarter tax payment. You'll have to evaluate that to see what tax might be due from that gain event that took place on 12/31/2026. But at a minimum, the tax will be due no later than April 15th of 2027 on that deferred gain. Just real quickly on that deferred gain, there's a few little things that I think the group might like to hear. One, if you held that investment in your fund for 7 years, you only pay tax on that deferred gain 85%. You get a 15% haircut.
Yes.
If you held that investment in that OZ fund for 5 years, you'll get a 10% haircut. You only pay tax on 90% of the gain in 2026. And then anyone else who's held it less than 5 years through 2026, you'll pay tax on 100% of that deferred gain. There's a calculation, though, just real quickly, there's a calculation that says the gain that is going to be recognized in 2026 on December 31st, 2026, the gain that will be recognized as the lesser of, it's a calculation. It's the lesser of the gain based on that formula I just went over with you, lesser of that number compared to the value of your ownership interest in the Qualified Opportunity Zone Fund. So the smaller of, so for example, if your gain is $1 million, and that's the taxable amount, but the value of your ownership interest in the Qualified Opportunity Zone Fund is $500,000. That's the value. then you only pay tax on 500,000. The other 500,000 is tax free. So you pay tax on your deferred gain, the lesser of the gain that you're going to recognize in 2026 or the value of your ownership interest in the fund. Some of these projects that have, and then the fund's value, by the way, is determined by its ownership interest in the QOZB, which is the operating company. So your ultimate ownership interest in the fund is really based on the actual activity of the business, the lower business. And many of these projects have not gone as well as some have anticipated. Interest rates have increased, cost of construction has increased. Maybe you didn't secure the tenant you were hoping to secure, and the value of that project has declined, possibly. And it would require an appraisal and a formal business valuation to ultimately determine your ownership interest. But nevertheless, it's the lesser of, and many are not aware of that. And so as accountants, we're going to have to follow it.
Interesting. So in a situation where the performance of the asset was not as anticipated, and your ownership interest within that QOZB is less than what the gain would have been when you realized, then you would pay the tax on the ownership interest, essentially the amount that you've So that's interesting.
Yep. Like, just very quickly, Form 8997 is the tax form on your personal tax return that says, here is your deferred gain. And that typically you would look to that form, and that would be the amount that you would include as income in 2026, but not necessarily. It could be the smaller number.
Interesting. Well, that's interesting how that works. And then, another thing that I was curious about, because I was reading an article the other day about the OZ modifications and how they were trying to shrink the number of tracts that qualify based on the income requirements, but also kind of focus in on rural communities as beneficial as areas that they'd want to see more investment in. And then I also heard of something about that there may be some additional benefit to investing. I'm kind of curious if you could elaborate a little bit on that.
So when these tracts get designated in 26, effective 1/1/27, the ones that are in these rural communities, which again have an even much higher economic threshold, but the ones that are in rural communities and meet the threshold, projects that invest in there, and taxpayers who have deferred gains that they roll into a rural community, a census tract, your gain that you roll into that will be taxed 5 years later. So you'll have a 5-year deferral. Your 5-year deferral, if it's in a qualified rural area, will only be taxed at 70%. You get a 30% haircut. If it's not considered a rural area, you'll get a 10% haircut. You got to hold it for 5 years. You'll get a 10% haircut, period, pay tax on 90% of your gain. But if it's in a rural area, you'll pay tax on 70% of your gain. So that's the advantage.
Interesting. And then all the other rules regarding the future appreciation of the OZ would apply in this scenario. So if you held it for 10 years and then decided to sell in the future, your future appreciation of those in that asset would be tax-free. Is that correct?
Yeah. Yes. And so the group hears this. No one invests in an OZ just for the deferral of their gain. You get a delay in paying tax on your gain. You get a haircut on that gain that you're reinvesting, but that obviously doesn't thrill anyone to get into an OZ. The thrill is the 10-year hold, of course. And so, yes, the new rules and the old rules, if you hold your investment in the fund and the project, for 10 years and sell, the appreciation is tax-free, and any depreciation pursuant perhaps to a cost segregation study, any depreciation that you've claimed where the otherwise basis in the property has been reduced by that depreciation that's been allocated to the owners, none of that is recaptured. So you get a step up in all the depreciation that's been claimed. If the owner's capital is negative, the owner's capital gets stepped up to fair market value, and then the appreciation of the property, all of that is tax-free.
That's amazing. Yeah, and I mean that's one of the reasons why a lot of people look to get into opportunity zones to begin with, was because of that 10-year hold and the potential to be able to realize that scenario in the future. So that's amazing. So another strategy, which I know is huge for making, especially in this environment where a lot of these deals are very minimally penciling and maybe even not in year one, the bonus depreciation. So we obviously had, when the Trump tax cuts were initially initiated, there was a concept of call bonus depreciation, which I'd like you to kind of elaborate on and then explain how it's progressed to this point and now what it's going to look like going forward.
I love it. many may not be aware, bonus depreciation, that whole concept originated September 11th, 2001. It was in the wake of what took place in this country and the economic slowdown that took place that they implemented bonus depreciation on purchasing, properties, purchasing qualifying equipment. And I think at the time it was like a 60% bonus depreciation. But in any case, that whole concept actually originated September 11th. Then it expired. Congress put it back in place. And recently, since 2017, beginning in 2018, it started out at 100%. In 2023, it was 80%. In 2024, it was 60%. In 2025, it's 40%. Unless, remember, like we're saying, these were, it was declining.
Yeah, it was going to go to zero.
Yeah, it was going to eventually go to zero. You're exactly right. And so Congress put it back to 100%. 100% is permanent. And it's for projects placed in service after January 19th, 2025, beginning January 20th, 2025, which is Trump's inauguration.
Yeah, nice.
Yeah, as you know.
Yeah.
So 100% bonus depreciation on qualified equipment, qualified improvement property for real estate, land improvement property. If you do a cost segregation study for real estate and you identify shorter-lived assets within that real estate, pursuant to the cost segregation study, 5-year assets, 7-year assets, 15-year assets. If there's qualified interior improvement property in commercial real estate, for example, all of that is 100% written off in year one, as long as it's, placed in service January 20th, 2025 or later.
Yeah. So just to give people perspective, for those of you guys who don't know what a cost segregation study is you hire a company that can come on site and essentially identify the different component parts of a building, because not every component part is going to be, the life cycle of a component part is going to be different depending on what the use case is. So maybe the flooring, I don't know the exact scheduling or anything, but maybe the flooring, they give you 10 years. Maybe it's only going to last 10 years, or maybe the doors, or different components of the building may be depreciated on different schedules, like he was describing. And so usually what you would do with a cost segregation study is you would depreciate those assets on each of the schedules that he's provided. So if it costs you 10 grand to do the floor and you depreciate it on a 10-year schedule, maybe you take $1,000 in depreciation per year. But what he's describing is once you identify all the breakdown of all the different component parts, you could take 100% of that depreciable value in year one. Is that correct?
Yeah. Like, for example, the default tax life for commercial rental real estate is 39 years. That's the default tax life. The default tax life for residential multifamily property is 27 and a half years. So without the cost segregation study, the default tax life is 39 or 27 and a half. In connection with the cost seg study, what you described is exactly the case. You identify these shorter-lived assets, which would include, as an example, there's many examples, but as an example, it would include potentially the wiring in the wall. If the wiring in the wall, which is hidden and actually part of the structure of the building, is tied to certain assets like computer equipment, for example, or other shorter-lived assets, the wiring in the wall can have a 5-year life.
Interesting. Yeah. And that's why these obviously, I'm sure you guys do it, but if you ever need a cost segregation study, I would highly encourage you guys to engage. But yes, I mean, there's companies out there that can handle this, and ultimately it can be a very powerful tool to be able to recapture some of the capital invested from year one. I mean, you take these huge losses on paper in year one such that you can juice up the returns, especially early on in the project cycle. So
the planning, by the way, just to tell you, is when the property is placed in service, that is the year you can do the cost segregation study and claim the 100% bonus depreciation, which, as you noted, typically results in a loss. And then that loss could, potentially offset other sources of income. There's a lot of conversations surrounding that.
Sure.
But the planning is you don't necessarily have to do the cost segregation study in year one. So if the property, for example, is placed in service in 25, you could wait until 2028 and say, in 2028, I'm going to do the cost segregation study in tax year 2028 for property that was placed in service in 25 and claim my loss in tax year 28. Why would you do that? You may not need the deduction.
Yeah.
And if you claim the deduction early, pursuant to some of the NOL rules, you actually end up wasting that deduction that you otherwise would have been able to take 100% in 2028, which is another little theory concept. But when you carry over NOLs, you can't use them 100% in succeeding years. So if you generated the loss in 25, you wouldn't be able to use 100% of that loss in 28 when you needed it. But if you waited to do the cost seg, you could claim 100%.
And that's just a scenario. You reference 2028 for a particular reason, or is that just a scenario?
Just an example.
As
it
an
could
example.
be 29, 27, 30.
Whenever you,
Yes.
in a year where you project that you're going to need the losses, that's when you would typically want to perform the study.
It's very common with our clients that the property is placed in service and we do not do the cost segregation study in that year.
And that makes sense. And that's why you talk to someone who knows what they're talking about to advise you on these types of things. That's awesome.
The government enjoys looking at it, by the way, the IRS, if it gets pulled for audit, that study, that engineering study will likely get looked at.
Oh, I'm sure. Yeah. So you want to make sure you're buttoned up in all the ways you're doing that. So that's amazing. So another piece of the puzzle when it comes to the big, beautiful bill is the qualified production property. So I myself I don't know anything about it. So this is going to be a kind of a new topic for me to kind of learn about.
Well, good. Well, I'll tell you, it's new for me too.
Sure.
I want you to know this.
Yeah.
And there's going to be probably a ton of guidance and a number of articles written about it. But the big picture is for manufacturing facilities where the construction starts after, January 19th, beginning sometime January 20th into the future. That's when the construction of the facility
January 19th of this year.
Yeah, 2025. Okay. That's right. After January 19th of 25, those are beginning January 20th into the future. That's when the construction begins. That and it's a manufacturing facility, which there's rules on what that is considered, which we could talk a little bit about that. That facility substantially, not entirely, but substantially will be eligible for 100% write-off.
Whoa.
And it's an electable position. In other words, it's not necessarily bonus depreciation, but it'll operate like bonus depreciation. And it is an election, which we're going to get guidance on that, exactly what that means, meaning you don't necessarily have to claim it. And there'll be reasons why you wouldn't want to claim it. Because, for example, if you claim that and it reduces your basis and you sell it, obviously you're going to have a lower basis and you'll pay tax on the gain later. And there may be reasons why you don't want to claim that deduction because you may not need it. But nevertheless, it's an election, it's manufacturing property, it's new construction after January 19th, 2025, and acquisitions of warehouses or industrial buildings after January 19th, 2025. You want me to get into that a little bit?
Yeah, I mean that would be huge because you could have is it acquisitions of product that was developed this year, or is acquisition of product that was developed in the past?
It's acquisition of products that were developed in the past. I don't have the time frame in front of me. I could actually find it if you want me to.
Yeah.
But industrial buildings that have already existed, and there's a time frame like how old these industrial buildings actually need to be, that were not used for manufacturing operations, and then a manufacturer acquires it and uses it for qualified manufacturing operation, it too becomes eligible for qualified production property.
Interesting. So if I'm a manufacturer and I happen to find a logistics building that's not fit up for what I need, but I want to buy the building and fit it up to be a manufacturing facility for a widget that goes into a Ford car. So that would be qualified. You could qualify that as as part of this
QPP is what it's the acronym it's known as. Now keep in mind, remember, the warehouse could not have been considered a manufacturing facility prior to the purchase, prior to the sale. So just real quickly, like if you have two industrial buildings that a manufacturer is, all things being equal, is otherwise looking to buy, one of them previously was a manufacturing building. The other one was previously not a manufacturing building, and the manufacturer wants one of those facilities. The one obviously that was never manufacturing is going to be more valuable to the manufacturer buying, one of those properties. And so he's going to, or she will likely select the one that was, not a manufacturing facility, so they can treat it as a manufacturing facility and write off 100% of it. See what I'm suggesting?
Yeah.
That property for the commercial broker is going to be more valuable.
Absolutely.
All things being equal.
Oh, absolutely.
Okay.
Which is huge because now it incentivizes business owners to take legacy product that maybe was used as for one function and turn it into manufacturing, which is ultimately what
Yes.
I think the purpose of the bill was, is to try to create a boom of manufacturing domestically. So
we already are seeing it. Our clients are telling us we're onshoring our manufacturing operation into the United States. So we're going to either expand, construct, or buy. We already are seeing that occur.
That's great.
And just another quick little nuance with the rule: if you're a commercial landlord, so you're not the manufacturer, you're the landlord, you own the building and you lease it. The tenant is a manufacturer. You, as the landlord, which you own the building, will be ineligible. You will not be eligible for the QPP 100% benefit.
Okay. But in the case where you develop the building and you lease it to someone,
it's not going to work. Right. So here's what I'd like the group to hear. Okay. And this is an important concept. If you have a manufacturer, it's not uncommon, just to tell you this real quickly, Raphael, it's not uncommon that the manufacturer has their operations in one legal entity, and the same ownership group of that manufacturing operation will own the real estate in a separate LLC.
Yeah,
That's very common. They're brother, sister. That, without additional guidance, we would understand that arrangement where the LLC is brother, sister to the manufacturing operation, and the LLC, brother, sister, the landlord leases it to its related self-rental manufacturing tenant. Correct. That arrangement will not work. We think, based on the way the rules are written, that the manufacturer will have to own directly the facility. And it could be, and I think no one would dispute this, that this would work if the manufacturing entity owns 100% of an LLC, which that LLC would be disregarded, and that LLC owns the industrial manufacturing building. That would work. So if it's parent sub, 100%, that would work. But if it's brother, sister, the way the rules are written, we're not convinced that actually works. Now, the IRS could write it and say, wait a minute. There's another concept in the tax rules that say if it's an economic unit, meaning you've got the operation and the real estate in two separate legal entities, but the same ownership group owns both. The only reason you split it was for liability reasons, and it's an economic unit, and you make an election, that might fly, but we don't have guidance on that yet.
Yeah. So typically, to your point, the way that you've structured, a lot of owner users will structure it. If they own the real estate, is to have a separate entity that owns the real estate, and then they have their own operating entity that leases from that entity that owns the real estate.
Right.
What you're saying is, based on the way this legislation is written, it looks like the mechanics of that may make them eligible for this election. But if they were to have a LLC that is 100% owned by the manufacturer, and it just so happens that LLC owns the LLC, it seems like the same thing, but to your point, it's the structure, how it flows, that it's a little bit different.
You still have a lease agreement. Even if the manufacturer owns 100% of the LLC, you'd have a lease agreement, but it would be disregarded because it's all under one, venture ownership structure. Yeah.
Well, and that goes to show why it's important to engage professionals that understand how this works, so you can eliminate or at least limit the potential loss if in fact you get audited and all of a sudden now you're in a pickle because the way that it's written, interpretation is wrong. So
there's nuances, like, just quickly, and again, we're going to get guidance on this, I'm sure, but how much manufacturing in that facility do you need in order for it to qualify as qualified production property? So, for example, if you had 75% dedicated to qualifying production, manufacturing activity, and 25% is just a distribution center, maybe unrelated to the manufacturing operation. So 75% is qualified manufacturing activity, 25% is not. Is it the 25% that just doesn't qualify, or does that taint the whole activity because you've got that kind of distribution taking place within the facility? You can exaggerate for a second if you have 5% qualified manufacturing and 95%, unrelated distribution. I think everyone could see that probably would not qualify.
Sure. Yeah. And that, I'm assuming at a certain point, it comes down to the fact that you got to kind of, it's a case by case basis where you have to kind of analyze. So as far as
we're looking for guidance.
No, absolutely. Okay, and I'm sure with this legislation, it's hundreds and hundreds and hundreds of pages. So, I'm sure some of the lawmakers probably still don't know,
Mm-hmm.
how this is all going to run through the system.
It's not uncommon, just to tell you this, Raphael, and I'm sure the group is aware of this as well. You've got the code, which is normally pretty broad, and then you have regulations that are issued later that give you specifics.
Sure.
So we're probably going to get regulations.
I'm sure.
Okay.
That makes sense. So as far as the lessons learned thus far, I mean, how can agents, brokers, other real estate professionals benefit from some of these legislations? So you described the qualified production property. I mean, is this something that, if I'm a broker and I have an industrial building, now I maybe pivot the way that I market the building to say, hey, manufacturing clients, hey, look at our building, because this is a new benefit that you could potentially have a benefit from, and this could create some value add.
Yeah, I mean, clearly, if it's purchased with, if it had existed within the requisite period of time and it had not previously been a manufacturing facility, that obviously is going to be a highlight if you're marketing it to manufacturers. If you're marketing it to regular distributors, then it won't matter.
Sure. Yeah, but it's just something for you to know so that you understand how to best present the offerings that you have to the marketplace. So
yes,
it's very helpful. So one thing I'm curious about as well is we talk a little bit about interest expense limits. That's something that I know is going to be of value to not only people in the real estate space, but in other industries. But let's just focus in on the real estate space for now. So that'd be kind of helpful.
So this interest expense limit concept began 1/1/2018 with the 2017 legislation. So it's been around since the original Tax Act. And to get into this is strange, but originally there's so many things to say. Let me back up and say this.
Yeah.
No one needs to worry about this interest expense limit, meaning some of your interest expense would be non-deductible. No one needs to worry about that unless you exceed certain thresholds. So I want to hit those thresholds real quick. It's only if you have a certain amount of revenue in your total operation where this interest expense limit would even apply. So for example, just small developers, and that term is, you can use loosely, but small developers, they don't even need to worry about this interest expense limit. They 100% of the interest will be deducted and they don't need to worry about it. It's large developers that need to worry about it. So what's considered a large developer? Normally it's a look back in 2025. If the prior 3 years, the revenue was $31 million or more, then this interest limit component, you need to look at it. And even if you have $31 million or more prior average revenue, in 2025, 24, 23, 22, and the average is 31 million, even you have that revenue and you have interest expense in 2025, that alone doesn't mean your interest is going to get limited. There's a calculation.
Sure.
So you got questions on that, Raphael, before I say any more? I'm going to tell you.
No, I would like to elaborate a little bit on that. That'd be helpful.
All right. So the interest limit applies to large projects is what I want you to hear. Now, one thought on that. If the partnership, which is a single asset partnership, and that partnership has investors, and that project itself, and you do the look back, is less than 31 million, you think, well, wait a minute, we're under the threshold. Our interest is not subject to any kind of limit calculation. Our interest is 100% deductible.
Interest from mortgage. You're describing
mortgage interest on the property. That's correct.
Yeah.
You borrowed money. You put in your own capital. You borrowed money to buy the property. You borrowed money to improve the property.
Yeah.
That interest, and you're thinking our activity is under the $31 million threshold. As far as revenue. Well, there's another test that you need to look at. If that venture is under the average $31 million threshold, but it has 5 or fewer owners that own 75% or more of the partnership, you got to look down to the owner activity. And if the owners have individually other projects that in total exceed the 31 million, then the venture itself that otherwise is not exceeding the $31 million revenue, it becomes subject to the interest limit calculations.
Wow.
Isn't that complicated?
That's super complicated.
And that all existed in 2018, beginning 1/1/2018, and that's carried over through today. What changed in the legislation is for the first few years, beginning in 2018, I could look at my notes, I think through 21, the first few years, when you did the interest limit calculation, it was like a full EBITDA calculation, meaning you could add back your interest expense, you could add back depreciation. Then you take this 30% calculation. If your interest expense did not exceed that 30% calculation after you added back those two numbers to your overall activity, then you're not subject to the interest limit. If you do the 30% calculation and the interest exceeds that 30% calculation, then you're subject to the interest limit and you've got another decision to make. But I want you to hear the first thing that took place under the old rule is for the first few years, it was a full EBITDA calculation, which was preferred. In other words, you wanted to add back interest and depreciation and apply the 30% test because you're applying it to a larger number.
Sure.
Because you get to add back.
You want to have the highest number you possibly can. So
That's 100%. Exactly right. All right.
Yeah.
Recently, since again, I could look at my notes, but I think beginning in 22, so 22, 23, 24, the rule has said that you can only add back the interest. You cannot add back the depreciation. So it's a smaller base for which to apply to 30%, and more taxpayers were becoming subject to the interest limitation. So the legislation said, we'll go back to the original rules, 2018, 2019, 2020, those first few years, and let you do the full EBITDA calculation. Does that make sense? So you get a larger base.
Sure.
For which to apply the calculation and hopefully not fall prey to the interest limit.
Sure. So that is what now is implemented to where you can essentially have a higher threshold for not qualifying for the limit, the expense limit.
You're exactly right. So beginning 1/1/25, you get a higher threshold. You get the full EBITDA calculation. If you fall prey beginning 1/1/25, even with the higher threshold, and you still fall prey to the interest limit, you have two decisions to make at that point. One, just let the excess interest, which is non-deductible, which by the way, for some taxpayers could be millions,
yeah, I'm sure. If
on
you're
the borrowed money,
some big
hundreds of thousands of dollars. Exactly. So your alternative is let the interest expense carry over and you can utilize it in a future year. When that threshold calculation is larger, you can just bring some of that disallowed interest and take it in a future year. So you don't lose it necessarily. You can just claim it later, or you can make an election. And the election is kind of fun, and it's only available to real estate trades or businesses. And that's an interesting concept, but the activity has to rise to the level of a trade or business in order to make this election. But I'll just say this, many rental real estate operations where it's like full developers, employees, full operation, their rental properties would be eligible for the election I'm about ready to tell you, which would get you out of the interest limit. So here it is. You make what's called a 163J election. It's like an ADS. That means the otherwise depreciable life of your property, which is 39 years, turns to 40. So it's like, who cares? In other words, you add one more year to the life of your property. And by making that election, which is irrevocable, and I'm going to tell you here in a second why you would not want to make this election. But if you made the election, the only downside is the tax life of your property changes from 39 to 40. So you get a little less depreciation, but none of your interest expense is limited. That's not half bad. If it's multifamily, your tax life of your property, which like we talked about was otherwise 27 and a half, it becomes 30 years. But then you have no limit on your interest. So you sacrifice annual depreciation for no limit on your interest expense. When you make that election, though, for commercial property, the downside, and there really is little downside for multifamily other than 27 and a half to 30 year tax life to make that 163J election. The downside to making that election for industrial buildings or commercial property is when you, in the future, you know how you have tenant build outs?
Yeah.
Those tenant build outs today are now, you can have 100% bonus depreciation. You can write off the tenant build out 100%, year one pursuant to the bonus depreciation rules. Well, in any case, if you make that election on commercial property, you can no longer do that. So you can have bonus depreciation and I don't know if you want me to get into the absolute weeds of that, but you can still have bonus depreciation on that property, but it will not the otherwise default qualified improvement property, which would be default eligible for the 100% bonus, becomes ineligible for 100% bonus. So I could tell you a little bit more about that, but I'll just leave it at that for now.
No, I mean, it seems like a complicated subject that is going to require a level of involvement from a professional to determine whether or not it's worthwhile for them to do, because it's just, to your point, it's not going to be the right move for everyone. But maybe if you do the math and you figure out, okay, well, the benefit of taking that to the bonus depreciation with those items versus what you're saving or you're potentially allowing yourself to take as far as the interest expense, if that outweighs it, then you say, okay, well, maybe this is the right election for me, but it may not be the case in every scenario. So
we'll hire you.
Will hire me.
No. Yeah, you nailed it. That is exactly the analysis. The thing that worries the accountants is it's an irrevocable election.
Correct. So there's no going back.
That's exactly right. What might seem good for the next few years may be a bad idea.
Because you can't go back and amend your return. You
can't go back and you can't reverse the election. You can't say, well, I didn't intend to do this. It's too bad. You've already made it.
Interesting. Well, that's going to be interesting to see how in what scenarios that may apply.
Yes.
But so one thing I was curious about, and this is one of the items that we were kind of briefly touching on prior to going live, was related to pass-through entity for withholding, and how does it going to affect partnerships, S corps, et cetera, which is obviously something that's going to be applicable to our industry.
Good. So everyone has heard of the SALT limit. The SALT limit is on your individual tax return. The total through 24, the total state and local tax deduction for an individual taxpayer is $10,000 a year. In other words, it's virtually zero. And that includes, property tax on your house, state tax payments for earned income, all of that default without the PTET election, which we'll talk here in a second, is limited to $10,000. Virtually, it's non-deductible. So for pass-through entities where an investor gets a K-1, they hold an ownership interest in a pass-through entity, S corporation or partnership, LLC tax as a partnership, for example. The partnership, the venture, can make an election that says we would like to pay the state tax on the earnings for all the owners and deduct the state tax for federal tax purposes at the entity level, which means no limit. And the state tax for some of these ventures, again, could be, hundreds of thousands of dollars that otherwise would be virtually zero for all the owners. So if the entity makes the election, called the PTET, pass-through entity tax election, makes the election at the entity level, it can deduct the state tax at the entity level. Then the owners on their K-1, since the entity paid the state tax on their behalf, they get a full credit on their state tax return at their individual level.
Wow. So it essentially allows them to take that, for lack of a better word, the deduction on their taxes, so they benefit more than they would have otherwise in that scenario.
Indiana and Kentucky, I believe, began that permitted pass-through entities to make that election tax year 2021. And then other states had started that prior to 21, like a handful. And today, this is not exactly the case, but today it's virtually across the country that states permit these pass-through entities to make this election to deduct the tax at the entity level. And there was discussion in the course of the legislation that passed on July 4th, leading up to that date, that the PTET would go away, which means we'll be back to the otherwise $10,000 limit.
Sure.
Congress did change the $10,000 limit to $40,000. So at the individual level, they did raise the SALT cap from 10,000 to 40. But if the PTET had gone away, you would be limited to 40. And again, for many who own multiple interests in multiple pass-through companies, they still would have lost out.
Would have not benefited as much as they could have, because if you have 5 or 6 entities and they're all having, their cost associated with that, and then passes through to you're probably going to hit that $40,000 threshold.
You'll hit it quick. Correct.
Yeah.
And just to make it fun, that $40,000 deduction becomes an AMT add back, which means even if you receive 100% benefit of your state tax, you could still lose it pursuant to AMT tax adjustments. So it could still offset, which is a whole nother conversation.
Interesting. Okay.
Yeah, okay.
So that's a fascinating topic, and obviously one that's going to apply to a lot of people that are in an LP position in some of these larger entities.
The PTET is not subject to any AMT limits. It's non-deductible for state tax purposes, but it's fully deductible for federal tax purposes in the states that permit it.
Sure.
Okay.
That makes sense. So in the case of who could benefit from this information, if you yourself are operating a company that owns real estate that incorporates a lot of passive investors, maybe this could be at least something to know, so that you can ultimately talk to your accountant, or maybe even reach out to Stephen to kind of see ways that you can properly structure everything such that you can you could add an additional benefit to your clients. So
right. I think, and I hate to say it this way, but we're just talking.
Mm-hmm.
It's almost malpractice not to bring it up
Mm-hmm.
and to suggest, especially if it's a material number,
Mm-hmm.
to suggest that the state tax and the election should be made at the entity level, so there otherwise isn't a limit at the owner level.
Mm-hmm.
So you have to have the conversation to see if, and normally it makes sense to do it.
Awesome. Well, that's super helpful. So one last question before we open up to Q&A, because I know there's several people online, and so far, great discussion. Greg Friend, he said, excellent discussion, guys. Will also was on the call as well. That's exciting. So knowing what we know now, right, with at least the high level understanding of what the big beautiful bill is, and obviously you've talked about likely still trying to figure out how this is all going to play out in the broader scale. There's going to need to be regulations that are passed down to give guidance to people to properly implement these strategies. But I guess my question is, how are you talking to your clients? What type of tax planning or business planning are you doing to kind of prep your real estate clients, particularly for the next few years?
We're looking at whether this is ongoing planning. The planning really hasn't changed much, except the bonus depreciation, I think, has put, deductions on the table, and the QPP has put deductions on the table that to such a material amount that it makes, do you want to do 1031 exchanges? Do you want to, when you have a gain event, do you want to defer the gain? If you choose to recognize the gain, I'll tell the group this real quickly. This is one of the things. It's called like a backdoor 1031. So you can go through a traditional 1031, sell the property, put the money in a qualified intermediary, reinvest it within 180 days, and then you don't typically, if it's all done properly, you don't pay tax on the gain because you rolled it over pursuant to a 1031. I know your group is aware of that. A soft 1031 would be, you don't go through the traditional qualified intermediary. You don't, in other words, put the money in an escrow. You sell the property, recognize the gain. Then, this is the key, in the same tax year, you buy replacement property, but you just don't purchase it through a qualified intermediary. You just buy it outright. So you recognize your gain. You got the gain that was incurred like in 2025, but in 2025, the same year, you buy other property. Well, if that other property, pursuant to a cost segregation study and 100% bonus depreciation, that property and that cost segregation study would likely offset the gain maybe entirely.
Wow. So
that's the planning.
And that's great, because one of the things that we often hear from clients regarding 1031 exchanges is the strict timelines, where you're pretty much, if you really want to make sure that you operate, or you finalize a 1031, is you have to stick to those timelines, the 45-day identification period, and then you have to close within 180 days. There's no exceptions. So oftentimes people buy stuff they're not wanting because they're of those timelines. So if you're talking about a scenario where you could maybe identify a property, buy it, and then sell your property, and all of a sudden, as long as you do everything within the same tax year, and you can do the cost segregation study and take the appropriate deductions, that you could very well have a scenario where you don't pay any capital gains on the realized gain.
Again, we'll hire you.
No.
You're exactly correct.
Yeah.
So if you have the sale of property early in a year, January, February, and you're exactly right, you're not sure you're going to be able to identify within 180 days, but you knew within the third or fourth quarter, that you would probably find property and purchase it. You just do a soft 1031 and do the cost segregation study and the bonus depreciation, you'll be fine. If the bonus depreciation had remained at 40%, as which is what it would have been in 2025, and as we noted, it would have continued to go down. If bonus depreciation would have been 40%, then the soft 1031 strategy would not work. But with 100% bonus depreciation, it likely works.
Wow. That's super beneficial. So in a situation where you're advising clients, this could be another strategy that you guys can employ, because sometimes people don't want to sell their building because they're like, hey, I need to identify my up leg. I don't want to put myself in a position where I'm stuck. Sold my property and now I have to identify a property, and if I can't find something I like, I'm having to buy something I really don't want to own. So you create a scenario whereby now you advise your seller and say, look, we can sell the property, and as long as we buy something within this timeline and we can execute a cost segregation study and take 100% bonus depreciation,
that's right,
it could accomplish the same thing you're trying to accomplish.
That's right. So, and then we're obviously already having conversations about the OZ incentive. You know, the extension. What does the extension mean? When they're going to identify properties? What do we do with my existing OZ project? We already are having those conversations. Clients who recognize stock portfolio gains. In other words, you sell publicly traded stock at a gain. The only real alternative, there's a couple other little strategies which are probably beyond this conversation, but the only real alternative to defer tax on that gain is to reinvest it into an OZ. And then you're going to pay tax under the new rules 5 years later, generally 90%, unless it's in the rural, pay tax on that gain at 70%. But the only real planning when you sell securities is OZ planning. And then if you sell real estate, it's either 1031 or OZ planning. It's one of the two.
Yeah. Fascinating stuff. Well, this has been super helpful so far. So I'm really looking forward to seeing some of the comments that pop up as a result of this discussion. But in the meantime, as we wait for more comments to come in, what is there a question maybe you wish that I would have asked you that I didn't get a chance to?
That's good.
Yeah.
We still have what's called QBI, the qualified business income deduction. That's a fancy way of saying you get a free, no question asked, 20% haircut on the profits of your venture if it's qualifying activity. Rental real estate is normally qualifying activity. So 20% of the profit could just vanish in a given year, where if your top rate is otherwise 37% tax bracket, and that income would otherwise get taxed at 37%. But if you have a 20% haircut pursuant to the QBI calculation, then your effective federal tax rate is 29.6, which puts your ordinary rate close to a capital gain rate. You got to think about that.
Yeah.
And that's been around since 2018 as well.
Cool.
And that there was discussion about that expiring, or they might tweak it a bit. They did some tweaks to it, but for the most part, it's as is.
That's great. Well, that's good to know that strategy is still available, which is great. All right. Well, let's see if we have any questions popping up.
While you're looking at that, I could tell you on the OZ front, beginning next year, 1/1/2026, there's new compliance reporting requirements. What does that mean? The QOZB, which is the operating venture, that entity is going to have to report certain activity within the venture that really has nothing to do whether the venture qualifies for the OZ incentive. So what does that mean? So for example, it's going to have to report employees, tenant activity, and there's some other things that I could look at, but there's a number of compliance reporting by the QOZB that will begin, and the Qualified Opportunity Zone Fund too, by the way, that will begin January 1, 2026. And those reporting requirements have nothing to do with the actual eligibility of the OZ, 10-year tax-free provision, any of that. It's simply census. It's data collection by the government. But it's an additional, and there's a number of items that are going to have to be accumulated, retained, and reported, annually to the government. We think it's going to be a new tax form. And that compliance begins 1/1/2026.
And that's curious you say that. So in that scenario, if you don't report properly, does that make it so that you could not continue on with that?
That's a great question. So they've said, that's a very good question. They've said that you won't lose your tax-free status, but the penalties are substantial.
Got it.
So if you don't comply and you don't properly comply, think about that. Just complying, you've got to properly comply. because there's going to have to be good faith. And
Mhm.
if it's obvious there's no good faith, then penalties will apply. And the penalties are pretty steep.
Sure.
Yeah.
That makes sense. All right. Well, it looks like you may have answered all the questions, and we're running up right on an hour. So I mean, Steven, I really appreciate your time. It's been great. It's been a great discussion.
Thank you very much.
No, absolutely. No, and
yeah.
and I'm glad we had this discussion, because I think that there's a lot of questions about this bill and how it's going to potentially impact our industry. I think we've based on the conversation we had thus far, I think there's several items within the bill that could be a net positive for the industry.
Oh, yeah.
Which is going to be a benefit.
Mm-hmm.
Yeah, which I think, again, as commercial real estate advisors, and really anyone in the commercial real estate industry, because we get people who are brokers, investors, attorneys, construction professionals. I mean, having a working knowledge about what legislation is going to impact our industry is going to be beneficial for you and your clients going forward. So hopefully you gain some value from this, and obviously we appreciate you coming on. So if people want to learn more about you or wanted to be able to get in touch with you to maybe even hire you for your services, what's the best way to do that?
Just through our website. If you go to Cherry Bekaert, and then you can search my name, and then my email address and contact information is right there.
Perfect. So we'll include that in the show notes. If you guys are watching this on YouTube, please go ahead in the description. We'll be able to access that. And if you guys are watching this in a podcast format, whether that's Apple Podcasts or Spotify, feel free to do that as well. So, Steven, great. Thank you so much for your time. It was really been a great conversation. If you guys are watching this on YouTube, please like and subscribe. It makes a huge impact on our ability to reach a broader audience, and we obviously greatly appreciate the support. Along with that, if you guys are watching this in a podcast format, whether that's Spotify, Apple Podcasts, whatever, please leave a 5-star review. The more 5-star reviews we get, the more people listen to the podcast, and it's obviously beneficial for everyone involved. So thanks again so much for tuning in, and we'll see you all next time.